Hello and welcome to another episode of The Big Perspective, where we talk to some of the smartest minds in the Indian markets and pick their brains about the biggest trends shaping the Indian markets.
A great idea which doesn't reach its audience is not a great idea.
I'm your host, Bhavya Dua. In today's episode, we have Aashish Somaiyaa, Executive Director and Chief Executive Officer at WhiteOak Capital Asset Management Limited. And we are going to discuss all things mutual funds.
If you do population multiplied by productivity, we have the best equation going.
Aashish is an experienced professional and has experience in scaling up and managing relations across well-known AMCs like Motilal Oswal AMC and ICICI Prudential AMC. And today, he's going to share his 2 decades of industry experience with us. So let's get going. All right, thank you so much, Aashish, for being on The Big Perspective, where we talk about the big perspective of everything markets and economy and the business. And with you, we're going to be talking about one of the biggest stocks in the towns, the mutual fund industry, what's happening there, how has it evolved over the last few years, and what is it that we can look ahead when we talk about mutual funds in India. So thank you so much for taking out the time and being with us today.
Thank you. Thanks for having me. Thank you.
So to start with, the mutual fund industry has grown from modest beginnings to managing around 40 lakh crore rupees in AUM today. So how do you think the transformation, what does it actually tell us about the India's financial landscape?
So much so that, 42 lakh crores is just the equity part of it. And then, there's fixed income and stuff. So, I think 2 things. One is that when we meet a lot of people, including, say, media commentators and, a lot of places where you read it, a lot of people seem to suggest that increasing participation is, because the stock markets have been booming and, because people are making returns post-COVID, etc., etc. I think that one needs to really think that how much of this, what is happening is just cyclical and how much of it is actually structural, right? My belief is that when you look at the cyclical element of the growth in the industry, yes, it's true that when markets are on an uptrend and when people want to invest in equities, equity mutual fund is a preferred mode. So obviously when people are making returns, market is on an uptrend, you expect some more people to kind of come in and get attracted.
Right.
But that's only on the margins. If you really ask me, the bigger trend is that it is structural in nature, right? The reason is because there's that many more participants, right? I mean, if you look at, say, people talk about demography, but if you put it in more pinpoint, more practical perspective, 21 years, 22 years, 23, 24, every 1 year of age, if you take that as an age bracket, there's anywhere between 2 to 2.5 crore people in India. Right. Now, obviously, when so many people are coming of age and when so many people are, beginning careers, some of them starting to earn money, obviously you expect them to start investing.
Right.
Right. So my sense is that this is kind of here to stay for the next 10, 15 years. Obvious question is why now? Correct. It's because of a generational change.
Right.
So let's say when I started my career, say when I was 20, 21 years old. That's long back, so let's not get into specifics. But at that time, interest rates were 12%. I mean, the RBI used to issue bonds on behalf of the government. That used to pay 12% tax-free.
Okay.
Right. If you put money in a post office, a monthly interest scheme gave 10%. So back in the day, nobody needed to invest in equity or in mutual funds unless it was just play money.
Right.
Correct. But today it's mainstream. If I tell your generation that you will get 12%, why don't you queue up at the post office? I'm sure you will say UI UX is really terrible. You won't do it. Right? So interest rates are much lower.
Yeah.
The whole experience, digitization, technology, that has changed things. And third, of course, is a proverb in English that habits change with generations. So my sense is, this huge growth we've seen in the last decade or so is largely structural. It's here to stay and it's only going to get bigger.
Okay. And for example, we have all obviously seen in the last, during COVID is when post that the number of DMATs accounts increased the most.
Yeah.
And post that market has been in an upcycle. And that's why we have seen more and more people enter, as you said, because the market has been going up. So you said for the next 10 to 15 years, it's here to stay. But if the markets are not in an upcycle, do you think people will still keep investing? The increase in the disposable income with people, the higher earning capacity, do you think that's also a factor?
So, look at it this way. I mean, I would just add something on, say, you said that post-COVID, the number of Demat accounts started to increase. I mean, the first time I observed it actually was after demonetization.
Okay.
Right. So, COVID was clearly one instance where we all were forced to engage with the digital world,
Right.
and offline was pretty much out of bounds. So, everybody had to be digital. But that that actually got kicked off with demonetization.
So 2016.
That is where digital interfaces, see, for the entire financial services industry, whether it is broking,
Yeah.
whether it is asset management, whether it is banking, COVID was one big impetus. But if you look at the banking industry, for instance, demonetization was a huge impetus to make everything digital, right? We started paying money and everything became digital after demonetization. So if you see, the first burst of whether you take payment apps, whether you take broking accounts, whether you take mutual fund accounts and SIPs, the first burst of digitization happened after 2016, early 2017 actually.
Right.
And from there on, we've been seeing an uptrend. This is obviously coincided with changing demography because that's the age cohort which adapts really fast.
Of course.
Correct? So I think that's where it started. And the second thing, on the cyclicality, see, it's a fact that every time the stock market is booming, IPOs are coming, right? You will find that much more number of people who find it easier to latch onto the market or jump into the market because they are motivated to do so. But that's just the cyclical element.
Right.
But behind that, there is, like I said, a huge structural force. I mean, that's the number of people entering the mainstream. So, I don't know whether it's 10%, 20% or 30%, but I would put it this way, that more than 50-60% of the influx is structural. And on the margins, there'll always be some people who will be demotivated when markets go down or motivated when the markets are booming. Correct?
So we talked about how it has changed from 2016 to now. But if we go a little longer back, when we talk about UTI's dominance to now the highly competitive market that we are operating in, what have been the key milestones that have shaped the industry the way it is right now?
I think a couple of them we already discussed, which is, like I said, that habits change with generations. So it's now people who are younger today, they are a bit more willing to engage with capital markets.
Right.
Second is the whole digital, online, paperless phenomena. And third, I already told you about interest rates.
Correct.
Beyond this, what we also need to understand is that back in the day, when I say 25, 30 years back, let us say when I started, what was my impression of the stock market? What was my impression of capital markets? What you're seeing today on OTT, say Scam 92, right? Or the, Telgi scam, for example, the stamp paper one, right?
Correct.
What you are seeing in OTT, people like me lived through it. It was not just economic times, it was Times of India and the tabloids, right? It's right up there. When we were young, out of college, starting a career, our perception of the stock market was not great. Like say for example, amongst families and friends, if you knew that somebody's kid started, investing, investing in the stock market and lost some money, the general chatter would be, "Inka bachcha galat line mein chala gaya. He's not, a guy to bank on." Would find it difficult to get him married or something like that. Right. So the stock market was the Wild West. That was the perception, at least. But if you see in the last 25 years, again, two more things have changed apart from what we discussed. One, people who are 20 years today, the stock market that they are seeing is very different from what we saw 20, 30 years back. Correct? That is largely to the whole governance framework, our regulator. Right? I mean, things have changed dramatically in the last 25 years. It's well recognized we are the most transparent industry globally and amongst the cheapest. So part of it is that today's youngsters are seeing the stock market, the mutual fund industry very differently because regulation and the frameworks and their execution and the usage of technology in the execution, all of that has changed quite dramatically. The second thing is that people who are young today, their education level, their socio-economic background, their risk-taking ability, the prospects for the country and the markets that they are seeing versus what we saw, their confidence level versus our confidence level. I think the whole framework has changed. I mean, there's no comparison between 25 years back and now.
Right. I think there's less friction, almost negligible friction for people to enter into the markets at this point in time.
That's a very large thing,
Yeah, if I talk about myself, I think I made my first investment when I was in class 11th because we used to talk about mock trades in school. I did commerce, so it was a part of our regular extracurricular things. So when you're doing all of those things in school which did not exist before, then that comes into reality also. So now talking about SIPs, they've become the industry's backbone. But what makes SIPs a game changer for both investors as well as for AMCs?
See, I think, for asset management companies, if I put it this way, any profession or business, right? Ultimately, what you need is customers who are there for the long term, with whom you can have a engagement model And of course, you need to reward those customers.
Right.
There's no question of having customers with you if they are not feeling rewarded enough. Correct. So if you see from an asset management company's perspective, look, every business works hard to acquire clients, and every business would love it that if they work hard, do the right things, acquire clients, have a value proposition, then they would want their clients to stay with them for long, right?
Right.
From an asset management company's perspective, if there is a customer base out there, which has been exposed, the right way. And our industry does a lot of work. I think it's a unique industry in the world where everybody gets together and spends, billions on mutual funds. Sahi hai. There's no such example in the world. Right. That also is kudos to our association and the regulator. So we put so much effort to inculcate people into the system, and we want them to have a good experience and be with us for the long term. Now the way, the kind of beast that the stock market is. The reality is that it's very volatile. So which means that people who invest every month at every level of NAV, they are most likely to have a better entry point than anybody doing it on a discretionary basis.
Correct.
So if they have a better entry experience, if they have a better average entry point, the probability that they will make a good return over 3 to 5 years actually increases.
Right.
So if you see from an asset management company's perspective, the best way to give good experience to your investors is to induct them through SIPs. And if you see it from the customer's perspective, that is any which way the right way to participate in the stock market. I mean, we don't know which is the right entry point. That timing is difficult, and that there are so many statements about time in the market is more important than timing. Plus, most of us or a lot of us, we earn monthly income. Correct. And Mr. Buffett said that income minus expense is equal to saving is wrong maths. It should be income minus saving is equal to expense. So first you are supposed to save. So the right financial discipline, the right habits, the right experience of investing in the market, better probability for getting good returns, all of it just works very well for both parties.
Right. You have all actually shed a lot of light on the awareness and the kind of work that regulators and the association is doing, right? So the awareness level has surely increased a lot. Even so that there has been a rise in the participation from tier 2 and tier 3 cities. So how do you see this landscape changing further?
We are looking at tier 2 and tier 3 cities probably from variety of ways, like say for example infrastructure development, size of economy, and population, and there'll be many dynamics. But one thing we must not forget, that today whether you are in a metro city or a smaller metro or a state capital or say 200 kilometers away from a state capital, the reality is that the information arbitrage is pretty much killed. Right? I mean, if somebody is keen to learn, or if somebody is keen to consume some information, or if somebody is keen to find out something about a mutual fund or about anything related to investing, I think there's no information arbitrage. So I think that's the thing. And 25, 30 years back, you might say that, okay, a financial advisor or a wealth manager or a mutual fund distributor or even a customer in Mumbai, you might say that, okay, they might end up meeting more people from the stock market. So they might be slightly better informed. And, somebody who has nothing to do with Mumbai and Delhi might not chance upon such people. So they'll have less information.
Correct.
But today, doesn't work that way. Anybody who is sincere enough to consume the right information or source out the right knowledge, it is there.
There's no barrier or a wall for anyone
There's
to
absolutely
access
no barrier. I mean, and it's not just about financial markets, right? I mean, accessibility to everything, all barriers have gone down because information has been completely democratized.
Correct. Also, we have already talked about how the investor behavior, how the changing generations have been a catalyst to change in how the markets have changed. Correct? But how has the market structure changed because of the new investors?
So one impact clearly of the demography and the young investors and the new investors, there are a couple of impacts which I can, handily think of. One is that because they are, we spoke about information being democratized. Now, when information is democratized, for young participants, say younger asset management companies, newer asset management companies, it a little bit kind of levels the playing field. Because when information is democratized, you can imagine that the purchase decision will be more meritocratic.
Correct.
Let's put it this way. 25 years back, when the industry was nascent, like you said, there are a couple of public sector players and then, everybody else was just kind of coming in. At that point in time, when awareness of the category was just not there. So I'll tell you practical experience. What will happen? You go and explain somebody about a mutual fund. Because they are not aware and there's no history, they might end up telling you, I didn't understand much of what you're saying, but okay, if you're telling me, let me try, right? And then they'll buy a brand, which they trust.
Correct.
Right? So what will happen is that because you don't know how to measure performance, because there is not enough track record,
Correct.
and because category awareness is poor, you just buy a brand which is a surrogate for delivery of performance. That okay, if you have a brand, I assume you will be able to deliver.
Correct.
But today, what has happened because of democratization of information and younger people being able to consume information, today what happens is people have understood that this category is about delivering performance.
Yeah.
In the last 10 years, I have seen enough that if you perform, your brand automatically gets built.
Correct.
So previously, brand came first.
Performance later.
And the assumption was that if you have a brand, you will perform. But today, if you perform, let's say you start off, nobody knows you. If you consistently perform, your brand will automatically get built.
Correct.
Correct? And that's why you're seeing so many new players are able to establish themselves in the industry. So I think it has resulted in market holistically becoming more meritocratic. That's how I would put it.
So the next one is kind of a subtopic about whatever we were discussing right now, or maybe like an overlapping question, but retail investors are also now kind of governing how the landscape works in this particular market as of right now today. So what are the trends that we see from retail investors that has changed the product offerings by AMCs?
When you say that they are dominating the landscape, I assume we are talking about a larger part of the market flows is more domestic and more younger people and more domestic investors coming in. I think that when the market expands like this, right, you have more discerning customers, correct? So there will always be cohorts of people. So today, if you see, mutual fund industry has about 6 crore, unique clients,
Correct.
right? Which means that there will always be out of this 6 crore. Let us say there will be some 6 million or 60 lakhs, say who have been, I'm just throwing numbers off the hat, say who have 10 years of investing experience.
Right.
There will be another, let's say another couple of crore who have 5 years investing experience.
Right.
There will be another, say 2 to 3 crore who will be having less than 3 years investing experience, right? Which means that there will always be cohorts of people at different levels of experience of market cycles and cohorts of people with different level or length of experience of having invested, correct? So when that awareness increases, when you have so many different cohorts of people, obviously the number of product categories, see you can segment the market when you have large base. Previously it was one generic base, awareness was low, everybody was being inducted into a diversified equity mutual fund.
Correct.
That's it. There's only 1 or 2 categories. Beyond that, the awareness is not there and there's not much to segment. But when you have a large base of clients with varying levels of experience, with varying levels of being able to discern differences between products, with varying risk return expectations, then obviously you can segment.
Yeah.
Correct? I'm not saying all the funds that come are all relevant for everybody. Sometimes, we give so much choice, we end up confusing people. That's the negative fallout of it. It helps the industry segment better. It helps the smallest of niche. Let's say you do a thematic fund, which generally is assumed to be too niche and too risky for a large base of clients. But even for a niche segment, you will find that there are few 100,000 people who would want to subscribe to it because they find it relevant. So I think it has increased the product offering. It has increased our ability to segment and serve people probably much better.
So as against retail investors, institutional investors contribute to a significant part of the industry's AUM, right? So how is their behavior different from retail investors' behavior, and how do they actually help in stabilizing the market?
Sure. So see, when you look at institutions in India, barring, say, the government, obviously, there has been change of policies, I think, after 2015, where the government has obviously, encouraged pension funds.
Right.
Like the biggest being the Employees Provident Fund, right? So the government has been encouraging pension funds to invest in equities.
Correct.
And their preferred mode is to buy index funds or exchange traded funds, which are just buying Sensex and Nifty.
Correct.
So apart from that, you will find that there's not much institutional participation beyond that, right? There are a couple of, say, there'll be some insurance funds, there'll be some pension funds, right? There'll be, say, few public sector enterprises. So some of those. But beyond that, if you see, it's largely varying hues of, high net worth investors, affluent investors, retail investors.
Correct.
So I think the market is in that sense less institutional and a lot more retail, HNI, family office kind of. If you take the whole industry, my sense is about 15% would be really institutional, and large part of it will be the government's pension fund. But beyond that, I think institutional participation is not that
And why is
prevalent.
that the case?
Typically, if you see institutions in India, like I said, the culture for pension funds to invest into equities is probably 8 to 10 years back.
Correct.
It's set to rise, right? Because obviously, when you have more younger people, there's that much more number of people contributing. Correct. I'm sure there is great growth in the national pension scheme. There is growth in the EPFO corpuses, which end up buying index funds.
Correct.
So I think we are set to grow. But at this point in time, it's still early stages as far as institutionalization is concerned.
Got it. And again, you also talked about the shift to newer products when we talked about what kind of offerings do AMCs now have to provide. So are we seeing also a shift from investor participation from equity and debt to more hybrid and passive funds?
Yeah, so just one thing to add on the institutional part, just before we move forward. One of the things is that in India, say for example, globally, a lot of insurance companies and a lot of pension funds, they end up subscribing to index funds and ETFs, etc. Now in India, insurance companies have their own investment practice. Pension funds, some of them might end up buying mutual funds or index funds or ETFs. A lot of the pension contribution goes to the national pension scheme.
Right.
So as a result of this, insurance companies managing their own money, which means they are not an institutional participant beyond a point for mutual funds.
Correct.
The EPFO is a big participant for mutual funds. And the national pension scheme, obviously, they have their own pension managers.
Yes.
So I think institutionalization is increasing, but also at the same time, there are different regulators for different investments. And everything doesn't get participated into through an asset management company or through mutual funds, right? Moving on to your, next question. In our market, there is one quirk which I'm sure the government and regulators are trying to address. Taxation kind of sometimes determines investor choices.
Correct.
So in the past, what we have seen that investing in equity used to be one of the reasons why equity investing was preferred, apart from risk return and all those considerations. One of the things was obviously equity as an asset class was encouraged.
Correct.
Equity always had concessional taxation. I think now it's being kind of leveled out, but in the past equity had concessional taxation. And fixed income also had attractive taxation, but now you know that fixed income is fully taxed.
Right.
Correct. That's a place where hybrid funds do play some role, because in hybrid funds what we've seen is that the taxation is kind of intermediate between equity, and it's not as adverse as fixed income. It's kind of comparable, or not as attractive as equity, but somewhere in between.
Got it.
Correct. So one thing, whenever you think about, say, hybrid funds, equity funds, fixed income funds, at least in our country, you should keep in mind that some of these choices are also driven by
the taxation structure.
So that's an overlay you should keep in mind. You're seeing a lot of attractiveness or attraction towards hybrid funds. I think part of it is because of taxation. And why not? I mean, because hybrid funds do have different risk return profile. They're not pure fixed income. People are taking risk.
Right.
So if you want to encourage that as a safer mode of investing, maybe it's good to encourage that. So hybrid funds are seeing traction. And yes, the other place where the industry has done a fantastic job and where I think hybrid funds go much beyond just taxation is because, we have created these plethora of low volatility funds. I mean, everybody who enters into equity doesn't have the gumption to take 20% or 30% down on the portfolio, which kind of, happens unfortunately once in a while.
So when we're talking about equity, there's also been a talk about shortage of equity supply in the market. What does that really mean?
The good news is that there are a lot of issuances coming. When you say shortage of equity supply, maybe somewhere in some corner the suggestion is that there's a lot of money chasing few stocks. But I think that in the last few years, the most encouraging trend is that there is a steady supply. See, anybody raising money would be wary about market conditions. And, any promoter or anybody selling stake, anybody raising money wants healthy market conditions. They want the right price. And why not? So, subject to market conditions. But in the last few years, it's a great trend to see, really high quality companies coming into the market. So, I think supply is there. but supply depends on the right market conditions. And I think the quality of supply is improving leaps and bounds. I'll tell you why. Say a couple of decades back, 20, 30 years back, the given wisdom was that, if you participate in an IPO, you are taking untold risk.
Correct.
Because, promoter has no track record and, some bad experiences. People collect money and disappear and the businesses never go off ground and, those kinds of things. But that was 20, 30 years back. The construct was such that any entrepreneur wanting to start a business had either friends and family or the bank or straight IPO. There are not many ways to raise money.
Correct.
But look at what has happened in the last 15, 20 years. The private equity culture is kind of up and coming, right? Which means that a lot of companies which come for IPO today, they are coming after having spent 5, 10, 15 years in the cradle of some, established, credible private equity participant. And they are most likely to have 5, 10, 15 years of financials being made available with, great audit track record and those kinds of, data available to you.
Got it.
So I think supply is there. A lot of new sectors are opening up, for instance. If you see in the last few years, you have seen diagnostics, you have seen hospitals, you've obviously seen new age digital businesses, you've seen a lot more consumer discretionary, you've seen a lot more household electricals, you've seen food and restaurants coming up, correct? You've seen a lot more IT companies, more product companies. So my sense is that supply is there, you will have more supply, more businesses will come of age. And I don't think that's a challenge. In fact, because we have so much of interest in investing in the market, supply is a must.
So according to you, there's no shortage.
It's chicken and egg, right? I mean, if there is demand, there will be supply.
Correct.
You can't always match the pace, but I don't think that's a constraint, at least to my mind.
Got it, understood. So from this, let's move on to the regulatory landscape when we talk about the mutual fund industry. How do you think that has evolved over these last few years and decades?
See, I think it's a well-known fact that, well-known meaning widely discussed amongst, the industry, well accepted, the pace at which the mutual fund industry has grown. A lot of our growth is, according to me, directly attributable to what the regulator has done in the last 15 years.
As we discussed in the beginning as well.
Yeah, because, they have played a strong role in increasing transparency, a strong role in reducing cost of investing, a strong role in standardizing product offerings, ensuring that distribution practices, selling practices, right? Information disclosure. I mean, we have transparency of the highest order, right? And we have amongst the lowest cost. So, plus I'll tell you, let's say for example, to avoid malpractices in the market, the amount of technology deployment which is being done in order to, curb malpractices or to kind of nip them at the source. And it's the highest order. I can just give you one simple example. I don't know how many people will know this, but in the past, there was a practice that once in a year or couple of years, a regulator would have inspections of asset managers. And obviously, when you have an inspection, you present data and, how you're running the business and, so obviously, right, there'll be, all kinds of data could be called for and, you need to exhibit compliance, with the framework and stuff. But I don't know how many people know this or not, but today, the data which is being generated by any asset management company. So let's take an example. There is an asset management company which is processing, say, hundreds of purchases, hundreds of inflow transactions. You know that those are processed, at a particular end of day, NAV units are allotted and the data resides with the registrar, right? And then the units are allotted and, account statements sent, etc. And the money is deployed. When we deploy money, we purchase securities. Those securities are held with a custodian. So what happens is in the middle, there is the asset management company, which is managing the mutual fund. That mutual fund is a trust. The liability side of that book is managed by the registrar and the assets are held with the custodian. So you can imagine that everything that happens happens in between the custodian and the registrar. Correct? Every day, the data is live replicated by the regulator. So for example, if there is anything that happens which is, say, not in synchronization with the investment pattern of a particular fund, for instance, the custodian's books would reflect that the investment pattern is not in line with what it should be. And hence it would get replicated. And hence it would be available to the regulator.
So the check that used to happen once or twice a year is now
Yeah,
a
so
daily
what
practice.
was a on-site is a 24/7 continuous off-site surveillance.
Correct.
That is fabulous, right? It's very important. It keeps the industry healthy, it keeps the industry safe, and you have early warning signals if there is something which is not playing out.
Correct.
Correct, and then that for example, market abuse. Right, you have fantastic technology deployment to catch any form of market abuse, like any front running, insider trading, correlations between different types of trades that are happening in the market.
So when you're talking about these regulations, the tightening of risk disclosure for funds has also been a very significant move. So do you think that has made investors more discerning, or is it still like a work in progress?
See, I think there will always be some people who short circuit the process and who just look at last 1 year return.
Right.
Okay, I mean, that is part of education, that is part of experience. Every scheme that we have has a riskometer.
Okay.
Right? That riskometer actually tells you that, if it's a fixed income scheme, where does it fall? Is it high risk, medium risk? Where does it fall? And there are arithmetical parameters. That if this is the credit quality, if this is the liquidity and duration, then this is the risk grading. And it's not even decided by us. There's a third party rating agency who keeps track of our scheme portfolios. And the rating agency kind of dictates to us that, okay, because of this portfolio constitution, now your risk rating has changed.
Correct.
So automatically that riskometer needs to reflect a revised risk rating.
Risk rating.
This is transparency of the highest order. I mean, you don't need to ask anybody any questions. You don't need to read my portfolio.
Yeah.
Right? Below the portfolio disclosure, you can see a riskometer which says low risk, medium risk, high risk, very high risk.
Correct.
And it's at a glance. I mean, you can't miss it.
Correct. Absolutely. So if we move from the regulation part of the mutual fund industry to the products that have been offered, which we kind of touched base upon in the beginning, but if we go in depth about that, we talked about passive investing taking a leap and forth in the trend situation right now. So including ETFs and index funds. So with this beginning of a major shift in the industry, do you think active funds will still dominate?
So I'll tell you on a lighter note, what's your sense, Bhavya, if you ask 100 people, then how many of you are above average drivers? How many of you are an above average parent? How many of you are an above average listener? What is your sense? What percentage of people will raise their hand?
Won't most people say yes?
Even when you say above average?
People like to boost their own ego by saying above average.
But what's the reality? That 80% people can't be above average, right? Or 90%, like you said, most people, so you mean 80-90%. Do you think 80-90% of the people are above average? Is it mathematically possible? It's not possible. But the reality is that we are human beings. As long as 90% of the people in this world think that they're above average, there will be quest for alpha and there will be active funds. So that's the basic human construct, correct? Because human beings don't want to be average. An index is average.
Correct.
And 90% people think that they can beat the index. So that's, okay, the philosophical part of it. Leave that aside. I have no favorites because I have played a role in creating or contributing to both parts of the industry. Now coming to the investment case, right? Passive funds will always have a case and they will grow. Because even if you leave aside this alpha and beta and all the technical discussions, the reality is that if somebody enters the market today, I tell them many times, if you don't know what to buy, you buy the market. Now come to the active part. What's the business case or the investment case, more importantly, for the active part? The investment case is like this, see, whenever you have a discussion with somebody about passive funds versus active funds, they'll hold a discussion with you for precisely 3-4 minutes, and in the 5th minute, it will go to US and say that, okay, US is the mecca of investing, the people are not able to generate alpha. So if US alpha nahi hai, to in the next 10-20 years or next 5 years, even we will not have alpha. That is where I stop listening, because that means it's gone in the wrong direction. Because US market construct is not at all comparable to us. I'll tell you 2-3 things which most people don't seem to track. Do you know that in the US, from 1995 till about, say, 2020, 2021, and further now, the market cap in US has gone up 5x, from 13 trillion to now maybe 60 trillion plus. If the market cap goes up 5x, what would you expect will happen to the number of listed companies? Should it go up or go down? You would expect to go up. The number of listed companies has become half. So if you're a manager of public equities in the US, what you're finding is that the market cap has gone up 5x, but your playground has shrunk into half, which means that What is left in the market is mega cap, large cap,
Correct.
maybe some mid cap.
Yeah.
Right? Why that is happening is because in the US, they always tell you that 60-70%, market is dominated by institutions. But they don't tell you that 60-70% of the institutions' investment is going into alternates.
Okay.
Which means that buyout funds, those SPACs which became famous,
Right.
private equity funds, crossover, pre-IPO,
Right.
all forms of unlisted, correct? So what happens is that when a lot of money goes in the unlisted market, for example, buyout funds, the corpus in last 30 years has gone from practically nowhere to $2 trillion. What do these funds do? They buy out and get companies delisted.
Correct.
So the number of micro cap and small cap companies in the US is actually on the decline because institutions are buying alternates, and those alternate funds are either doing private equity or pre-IPO or buying out even listed companies. In the US, when an IPO comes, company has spent 12 to 15 years in the cradle of private equity, and then it comes for listing. When Uber gets listed at $75 billion and then does badly, where does the alpha go? It goes to the private equity market. So in the US, what has happened is that the alpha has got privatized.
Okay.
It's not that there is no alpha.
Yeah.
The challenge is that a lot of alpha has migrated to the alternate space. In India, we already have more than 2.5 times the number of listed companies as compared to US. So we are, let's say, well over 7,500 listed companies. US, I saw a couple of years back, was 3,500 listed companies.
Okay.
Second, in the US, when they talk of an IPO, we talk about Mr. Musk's companies getting listed, right? We're talking about SpaceX getting listed. In India, what do I say? Potato wafers and Sev Bhujia wala are getting listed. Right? So see the level of evolution of the market.
Correct.
So I would just put it this way, that there is scope for everything to be there in an investor's portfolio, and people will exercise their choices. But there is abundant potential to generate alpha in India. The last thing I'll tell you in India is that people think that fund management is all about stock picking. But anybody looking to generate consistent alpha is a lot about scientific portfolio construction. It's not just about stock picking. Because in India, I think there is stock picking is overrated and glorified, and portfolio construction is underrated. I think that sophistication is coming now.
So how do you think people can focus more on scientific portfolio construction, and how is that different?
Every 2 to 3 years, you will find that the best performing fund, fund house and fund manager changes. The guys who are number one today, in terms of recent performance, they were not doing so well 6 months back. The guys who were doing very well till 6 months back were in the dumps in 2020. The guy who was number one in 2020 is in the dumps now. Right? It's not that these guys lose their competency. What happens is that when macro environment changes, what works in the market also changes. So depending on which way interest rates move, depending on external macro, government policies, oil and commodity prices, the geopolitical environment, whenever macros change, which style, which sector, what market cap. So when those rotations happen, the best performing fund, fund house and fund manager also changes. Which means that a lot of alpha is being generated not by stock picking. Lot of alpha is being generated by mere chance that when PSU started flying, your portfolio was residing there. But man, you were always sitting on PSUs. You didn't predict the Ukraine war. So let's say when COVID came, everybody with a defensive portfolio did well. But they were always running defensive low beta portfolios. So what happens when the macro environment changes, it creates tailwind for somebody's portfolio and creates headwind for somebody else's portfolio, so the winner rotates.
Correct.
What investors should be looking for is consistency. Investors should be looking for portfolios which are balanced for macro conditions and generate return only from stock picking, irrespective of headwind becoming tailwind and tailwind becoming headwind. Let's say the portfolio is a blend of growth and value, blend of defensive and cyclical, well spread across large, mid and small. Not overly tilted towards private sector or public sector, cyclicals or defensives. So if you neutralize all the factors which are influenced by macro, then those factors will not cause headwind or tailwind. If you balance out. Then the real alpha from stock picking will show up. Today what is happening is a lot of alpha which is coming from headwinds and tailwinds is being assumed that it is the skill of stock picking. If you look at the institutionalized world, it's a well-known fact that any alpha you get because of macro headwinds or tailwinds or alignment of your portfolio to macros, any alpha which is fetched that way is attributed to luck. It is not replicable, it is not sustainable. Only the alpha which you are able to demonstrate after nullifying for all these factors, that alpha is seen to be or thought to be as a function of your skill and stock picking competency. I said we have great transparency. Some point in time, portfolio managers should also publish their attribution analysis. Attribution meaning where did the alpha come from?
Correct.
And how consistent is the alpha? So I would rather pick a manager who, when he or she is doing well, it's top quartile. And when the portfolio is not doing well, it lands up somewhere in the middle, like, bottom of second quartile or top of third quartile.
Correct.
That is more sustainable. Whereas I have seen that the guy who is number one, when does somebody become top of the charts, number one? When they only have the stuff in their portfolio which is tailwinded in the current market environment.
Correct.
So that tailwind definitely is going to become headwind. And this guy who's number one is most likely to go to number 20. And when the tailwind changes to headwind, the guy who's number 20 is quite likely to
be the number one.
But it's not happening because of their stock picking. It's happening because of the intrinsic tilts or imbalances in the portfolio, which is causing headwind, tailwind. I would rather go for a guy who's consistently in the top two quartiles.
Got it.
If some part of your portfolio gets tailwinded, you are like top quartile. And if some part of your portfolio gets headwinded, you like land up in the middle.
So as of right now, in the market, how much is the impact of these macros when you talk about these funds? What's the exposure like for the funds, how they're constructed?
See, I think macros are always at play. Certain macro conditions suit certain people's style.
Correct.
And those macro conditions hurt some people's style. Right? It's creating headwind for someone, creating tailwinds for someone. In my understanding, portfolio construction, like I said, is still underrated, not discussed enough. So I would wager, I don't have a percentage of assets in mind. I would wager that bulk of people's portfolios are imbalanced. And that is why winners keep rotating.
Got it.
And that is why, we are kind of discussing this at length. So it is appreciated and people ask the right questions. That, how much of the alpha is sustainable and what is the source of the alpha.
Right. Now that we're talking about macros and how much they impact the current industry and how the investment landscape as a whole, if we talk about India and India's economy, what is your view of the current narrative of the Indian growth story?
A lot of times we discuss, or it is stated about our country, that, it's the fastest growing economy in the world, rising fast in the league tables. See, look at it this way. I am no economist, so pardon the oversimplification. But
that's exactly what we are looking for here.
When you talk about growth, when at a country level, growth is always some function of population and productivity of the population. But when you talk about productivity, the single biggest determinant of productivity is the age.
Correct.
So 15-20 years back, if you see in India, most people were kids. Today, if you see, most people in India are in their early youth, like 20s.
Adults. Correct.
Right? The median age in India is below 30. In China is above 40, maybe 42 or something like that. So we are now reaching a stage where as a country, as a bunch of people, we are going to be at our productive best in terms of the age construct. Yes, we have our own challenges in terms of quality of education and giving these people the right kind of jobs. So you might argue that, okay, if are all these guys going to be able to contribute to the economy? Are they well equipped to contribute to the economy? Are we having a suboptimal kind of demographic dividend? All that is topic of debate. But on an absolute basis, the reality is that today we have the correct population construct for us to be able to accelerate our growth in the next 10, 15, 20 years. So we have that opportunity. We are at that juncture where, if you do population multiplied by productivity, we have the best equation going. Today, the problem for the world is that the largest economies in the world, or the countries which contribute most to the economic output of the world, they are all aging, right? If you see Europe, Japan, South Korea, Taiwan, increasingly China, they're not going to be able to reverse. And everybody is not America, which has like outstanding, fabulous immigration policies. Right? America is a unique example. Everybody can't be America.
Correct.
Right? Because America picks the smartest people from all over the world every year and admits them in their colleges and then makes them stay.
Correct.
So the rest of the world is not America. They just have to go with the flow of their demography. And I don't see anybody immigrating to China or South Korea or Japan, not even to most parts of Europe. So even if they want, they cannot have those immigration policies, which means that there will be, for every country, there will be that sweet spot of 15, 20 years or 25 years when they are at their productive best purely because of the arithmetic. For us, we are just at that juncture. For us, it's the next 15 years. Collectively, it's for all of us to make the best of it.
Right.
We probably, you know, the reforms that the government is making, technology, digitization, banking system,
Yeah.
lot of things we are getting it right. There are some things we need to do better, but I think we have that opportunity.
Yeah.
And the next 15, 20 years is definitely going to be better than the last 15, 20 years. That's what I would say.
Got it. Understood. So now that we have diverged a bit from what we were talking initially about the products and innovations happening in this space, we went and talked about macros and economy a bit too much here. So going back to products, if we talk about ESG, that's also something that's been picking up as a trend. Do you think it's ever going to become mainstream, or is it still niche and will remain niche for a long period of time?
Let's look at, for a moment, you know, let's take the liberty of parking, say, ESG as a label. Say it's, you know, environment, social and governance related
Correct.
considerations, right? A lot of people think that it's just a label. A lot of people think it's just some product category, some marketing. A lot of people think it's just some kind of propaganda. Just leave that aside and focus on the arithmetic of investing. When you try to figure out what the value of a business should be, so anybody who claims to be a bottom-up analyst, right? They would, you know, do a discounted cash flow method. So, you know, you would try to hypothesize the cash flows. How do you do year 1, year 2, year 3? I mean, how are you doing that hypothesis? When you say that, you know, I made a hypothesis for next 8 or 10 years of cash flows, and then there is a terminal value, and terminal value is a significant, like 60, 70, 80% part of that equation. So how do you sleep at night after doing that DCF? Obviously, sustainability is implied, right? If you think that this business is not sustainable, if you think that this business has poor governance, so if you think that I am hypothesizing cash flows for a business without making any assumption about its sustainability, that's a fool's errand. Right. I mean, anybody who's doing this is making certain assumptions, implicit or explicit,
Correct.
about sustainability.
Right.
Environmental, societal, and governance related considerations are essentials for sustainability. Why is it that certain businesses trade at 1, 2, 3, 4, and 5 price to earnings multiples, and why is it that certain businesses trade at 40, 50, 60? General arithmetic explanation is that it's because of growth. You know, companies which have great growth potential, they trade at higher multiples, but none of that growth is going to be actualized if it has poor governance.
Correct.
So multiples are first paid for governance, because any growth you assume, governance is a prerequisite, whether it's a country or a company. So I would say that it's core to investing. Well, yes, there are some investors or some investment firms which say that we practice ESG investing strictly. That's the whole and soul, that's the basis of investing, is obviously that is coming out of an awareness that when I am deploying my capital, it is not just highest return related consideration. It is not just about buying a business cheap. I want my capital to be well directed so that it doesn't cause harm to environment and society at large. The reality is that sustainability and assessment of sustainability is core to investing. It's just that some people choose not to keep that as an investment criteria. Right? But it's core to investing. It's implied, it's embedded everywhere.
Similarly, if you're talking about sectoral and thematic funds, they're also becoming increasingly popular. So what does that indicate of? Is it indicating that investors are becoming more sophisticated, or is it just because of the current market sentiment?
So you can look at it two ways. One, you can look at it that, okay, some people can diss it by saying it's a fad. It's just, you know, you're segmenting and slicing and dicing the mutual fund pie. And you're thinking of more and more ideas just to keep launching new products and NFOs. When you say pros and cons, those are the cons, right? Or that's a reason to diss the thought process. But I look at it differently. That, look at it this way. 20, 30 years back, if I told you that I want to create a banking and financial services fund, what would you buy? Mostly it was few PSU banks. And then few private sector banks came in.
Correct.
And maybe there was one large NBFC mortgage company like HDFC. there was no theme to talk about. But what is banking and financial services today? I mean, we can make a 35-40 stock diversified portfolio just within banking and financial services.
Correct.
Right? Because it moved from PSU banks to private banks, from private banks to NBFCs. Then NBFCs got segmented as, there are industrial lenders and mortgage lenders, and then there are credit card issuers and the whole stuff. Right? Then whole capital market space got added to financial services, right? So there are asset managers, wealth managers, depositories, exchanges, registrars, right? The whole works. And then there are insurance companies, and then there is health, general and life, right? So what has happened is that these thematic funds are invested in multiple subsectors. And one could potentially identify an area of the economy which is growing disproportionately than your diversified fund or your diversified index. Okay, yeah, if somebody tells me launch a logistics fund, I can understand that it's still narrow, right? But if you say, consumer staples, consumer discretionary, healthcare, digital, IT, ITES, banking and financial services, manufacturing, there are multiple subsectors within these. I mean, we have some 33 analysts covering 900 plus companies. We can make a 30 stock portfolio for pretty much every theme. And that's the depth of research, right? And some others also may have it.
Correct.
So I don't think that, I think there is a lot of potential in all of this. And, there are discerning investors. That's why they are interested in it.
Got it. Understood. And what about the rising popularity of AIFs and PMSs? How are they impacting your business in the market?
One way to look at it is that ultimately the return depends on the performance of the asset class and the performance of the manager who's investing on your behalf.
Correct.
Right? But at another level, these are different regulatory licenses awarded with different sets of possibilities. So let us say that if you want to do a VC fund, it has to be an AIF, right? If you're going to do pre-IPO unlisted, if you're going to do real estate, many of these asset classes or many of these investment combinations, they have to be in an AIF, because see, mutual funds are a mass retail product.
Correct.
Which is standardized to an extent that, everybody can understand. There are many things which you cannot allow a mutual fund to do, because the last mile is investing in a mutual fund. So AIFs are for different type of investment.
Correct.
Same way if you see PMS, Portfolio Management Service. Now even today in India, people holding stocks in their demat account is still a bigger number and a bigger corpus than people investing into mutual funds. Are you saying that everybody who's holding stocks directly in their demat are going to move into a mutual fund? Answer is no. Some of them might want to appoint a PMS manager to manage the portfolio on their behalf. A lot of wealth creation is happening in direct equity through stock options, right? There are people who are any which way holding and inheriting equity portfolios.
Correct.
So some people are used to investing directly into equity, having their demat accounts and trading. So some of those people may still choose to have a PMS manager. And a PMS is a bilateral agreement. Right? You can agree that, okay, this is the investment strategy, these are the charges.
Correct.
And you can pretty much write anything in that agreement as long as two people are agreeing to sign up.
Correct.
So PMS is a discretionary service, which is a bilateral agreement between the manager and the client. And it has different sets of execution possibilities, risk return combinations. Then there is AIF, which is, largely for illiquids and, for example, AIFs can leverage, they can borrow on behalf of customers, correct? And mutual funds are the mass retail vehicle, right? They are all for different purposes.
So with more people getting into AIFs and PMSs, how will the market change because of that?
No, it just helps us. See, it's good for the demand side of the economy. Like say, for example, let's take real estate, right? There are very many restrictions that the Reserve Bank of India imposes on banks and NBFCs when it comes to lending money for real estate projects like land acquisition and so many things. Now, a lot of those requirements are fulfilled by AIFs. We discussed about supply in the stock market, and I mentioned to you that private equity is now rising and coming of age. So obviously those venture funds and private equity growth funds, they need to be structured as long, 8, 10, 12 year long gestation funds. They cannot be a mutual fund. And AIFs have a minimum of 1 crore. But I'm sure the average ticket size of investing on an average in the industry may be 5 crore or 3 crore or something like that. Correct? So they are meant to fulfill different requirements for people who are raising capital and also different requirements for people who are investing.
Got it. So when you're talking about PMS, AIF, many other products and asset classes. What about the new asset class that SEBI has talked about? How will that impact the PMS business? Because there's a difference in the taxation between the two.
Yes, of course.
So how do you think that is going to impact the PMS business, and how is that going to impact the overall market in general?
See, I think what is happening with the new asset class is that the regulator has obviously proactively realized that, even I told you that, as time passes, there are different cohorts of investors with different levels of investing experience, different levels of ability to discern from investment options, and different risk return requirements. So now there is a significant base of mutual fund investors who are seasoned investors. They kind of understood how it works. Now, let us say in a mutual fund, there are certain restrictions that you can't have more than certain percentage in one stock. You have to have open-ended fund. You cannot make it close-ended, right? And you cannot have exit barriers. You cannot have gating, for instance. If it's a fixed income fund, you cannot have more exposure than a certain number to a certain sector or a certain bunch of issuers, right? So there are many such things. Now, what will happen in a new asset class is that a lot of this standardization and a lot of this risk aversion which is built into mutual funds will get relaxed with new asset class.
Correct.
Say a few years back, there was a situation where, credit funds, because they were witnessing outflows, they had to gate those funds, and then it was proven that, if you give up liquidity for some time, then the capital kind of can be preserved, right? That's what was the situation. So now you realize that if you want to do credit, you need to be in a closed-ended fund which does not allow redemption and outflow. But mutual funds have to be daily liquidity.
Correct.
So some of those credit opportunities can be built into this new asset class. Concentrated portfolios can be, because now for new asset class, the proposed thing is that, 15% per stock.
Correct.
Which means theoretically you can just mix 7 stocks or 6 stocks and some cash. A lot of the latitude which was not available to mutual funds is now being given to them. Just that they should not do it in their normal mutual fund. It has to be created as separate scheme which is called as a new asset class or a different investment strategy. And on your question, yes, some business from PMS and some business even from AIFs will get pulled into this new asset class. That's my expectation.
Correct.
I mean, I don't know yet. We don't have the final guidelines. Purely at a surface level evaluation, I do believe that some of the things which were being hitherto practiced in a PMS or in a closed-ended AIF, some of those things may move to a new asset class. For example, we don't believe that we should manage too much of small cap, mid cap money in an open-ended fund because it's very volatile. So generally, we launch small cap, micro cap stuff only in a closed-ended AIF. But now we might move that to new asset class as and when it comes up. Right? So many strategies which require the outflow to be gated, illiquidity to be built in.
Got it. So now that you said that it will impact both PMS and AIF, how will that impact the AMC business?
It's actually positive and value accretive for the AMC business. There I have no doubt about it. But say there is somebody who's a great PMS manager and then, like you pointed out, this new asset class is a fund structure, right? It's a mutual fund trust. That's what is proposed at least, which means that it will have certain benefits which a open-ended PMS does not have because it's not a fund structure.
Correct.
So the levels of operational intensity and convenience changes. The impact of taxation also changes if it's a fund structure versus a segregated structure. So yes, my sense is that for asset management companies, it is value accretive. And for AIFs and PMS, maybe the competition would kind of increase.
Got it. Understood. And do you plan to launch one once the guidelines are out?
Oh, yes. Of course, we'll work on it.
Also, when we talk about the investor sentiment in terms of whatever is happening in the market, there's been a shift towards direct plans and fintech platforms. That has also disrupted the traditional distribution channel, so to say. How has this affected the access and also the costs for investors?
See, it's like this. There are a lot of people who feel that, they are capable of investing directly.
Yeah.
Or for whom, access is a great, you're just sitting, somewhere and, you can access your phone, access, convenience.
You see every second person doing that.
It's convenience, it's access, right? It's the feeling that, okay, I'm empowered, I can do it myself. So it's a boon, because obviously the fintechs and the digital platforms have, pulled in millions and, the traditional distribution, the offline distribution, if we were relying only on offline distribution, then this amount of accretion of client base was obviously going to be impossible.
Correct.
right? Because we can't just depend on mutual fund distributors and bank branches for people to queue up and say, I want to buy a mutual fund. So there's no doubt that fintechs and digital platforms have resulted in a kind of an explosion of client base, because the access has just been democratized, like
Correct.
I said earlier also.
Correct.
But what you should also keep in mind is that is the whole industry which is growing and expanding, right? So it's across the board. So when you look at broking, for example, the fintechs and the online brokers have grown,
Yeah.
but parallelly traditional brokers have also grown. If you see the mutual fund industry,
Yeah.
mutual fund distributors have also grown, bank distribution has also grown, and of course fintechs and direct. So what is happening is that because of the earlier demography and the structural advantage in the economy, what is happening is that everything is kind of growing. Some growing faster, like online channels or digital channels growing faster than the rest, but everybody is growing. So it's not yet impacting or causing any one mode of working to suffer really. It's just that something is growing faster. The second thing you should keep in mind is that, especially when it comes to mutual funds, second is when people come into money, they don't remain DIY, right? Then they need consultation and
True.
so I think people move from channels and modes of engagement. It never gets cast in stone. So I would put it that the fintech channels and the online platforms are pulling in a lot of customers.
Once they become sophisticated.
But they are expanding the pool for the overall industry itself.
So in that case, independent financial advisors and traditional distributors still play a significant role in the industry.
Yeah, because see, somewhere people want engagement.
Yeah.
See, the mode of compensation.
When you're dealing
and
with
the-
like huge amounts of sums of money,
Yeah.
then you don't want to just go on an app and do it yourself. You want more consulting. more
people might
to
want.
guide
And
you.
see, I mean, when people come into money, they would want to deal with a private banker or a wealth manager or an advisor. And it's not just about which scheme to invest. Look, there's a lot of stuff, right? There is succession planning, there is estate planning, there is taxation.
Correct.
There is taxation to manage, correct? And sometimes the industry can be complicated. I tell so many times on a lighter note that to buy some 500 good stocks, we have 5,000 mutual funds, correct? And the difference between the best performer was, I mean, a few minutes back we were discussing about alpha and how to evaluate alpha and attribution of performance.
Correct.
Right? And we were talking about people asking the right questions.
Yeah.
I mean, all of this will need facilitation.
Correct. So in that case, what do you think? How is the robo-advisory or the AI-driven advisory driving the industry?
So I think all models have a place and all models will have subscribers. That's the beauty of being in such a vast market, right?
How do you see this evolving further in India?
No, I think all forms of engagement will, see, because it's a cliche that there are many Indias, right? So I think because of the size of the market, like even in an earlier context, I made a point that when the market is growing so rapidly and it has a huge size, so you will pretty much find a market for every offering. It's like that, right? So, when there is somebody who instead of doing DIY, wants guidance, but remote guidance, online guidance, then obviously robo-advisory also has a role to play. When somebody wants ready-made portfolios, that okay, I'm going to put 50,000 or 20,000 or 10,000 per month, and my risk return profile is bunged in. So you just tell me where this money has to be directed, like a pre-packaged solution. So I think there is space for all of this to be executed on a robo platform.
Got it. While discussing about platforms, let's move on to another segment where we discuss about the AMC business and how does that actually work. Do you see there is enough room for niche players to grow?
See, the market itself has expanded so much. It is competitive, but just to give you a sense of scale, somewhere in 2012, I remember, equity mutual fund industry was about 1.7 lakh crores. Even if you go 5-6 years back, it was 16-17 lakh crores. Right? And now it is well north of 40-42 lakh crores.
Yeah.
Correct. So first thing, Bhavya, you should keep in mind is that if the industry is expanding so rapidly, you can't expect that there will be 20 players who will keep growing. And then there is that much growth in the PMS industry, which has gone from nowhere to some 5-6 lakh crores. And that much growth in the AIF industry, like 2012 AIFs didn't exist. And today they are also some 5-6-7 lakh crores, right? So there is growth across the board. And this growth will not just go to some 10 incumbents, right? As you have more customer base, as you have more growth, people will find their, entry point into the industry by positioning themselves, by segmenting the offerings, by segmenting the customer base. So you will find not an explosion, but definitely you will find a greater proliferation of new participants coming in.
Got it.
And when you see more and more participants coming in, you will feel that it's getting more competitive. It is competitive, it should be competitive, it's good for customers. But there is also just the sheer size and the space for everyone and the ability to segment, where people can create their space. Last thing I think is that ultimately when you're in the investment management business, 90% rule of the business is investing. I mean, I always believe that, a great idea which doesn't reach its audience is not a great idea.